Why is it that as the world appears to grow more chaotic, the global economy remains strangely calm? Pundits warn of a polycrisis, yet markets continue to reach for all-time highs. This isn't just optimism. It's a fundamental disconnect that signals a profound change in the very nature of our economic system. The common interpretation is that higher geopolitical risk must lead to economic decline. But history occasionally offers a different lesson. In 1940, as France fell, British investors bought stocks, correctly betting that the system would endure. Today, we see a similar pattern. From the euro crisis to the invasion of Ukraine, global GDP growth has held steady. The question is no longer if the economy will weather the next storm, but why it has become so resilient. Are we witnessing the emergence of a new economic architecture, one that is structurally insulated from political shock? The first layer of this new resilience is found within the private sector. The narrative of fragile supply chains has been proven largely wrong. Today's supply chains are not brittle lines, but dynamic, intelligent networks, run by a growing class of professional managers using advanced data and logistics. They can absorb and reroute around disruptions with unprecedented efficiency. This corporate agility is bolstered by a structural shift in advanced economies towards services, which are inherently more stable and less prone to the sharp contractions seen in manufacturing. This adaptability extends to the bedrock of the global economy, energy. The rise of new producers, particularly American shale, has decentralized energy supply, weakening the leverage of traditional cartels. The world economy is also simply less thirsty for oil than it was in the 20th century, consuming nearly 60% less oil per unit of GDP since the 1970s. The global system can now absorb energy price shocks that would have once triggered deep recessions. We are seeing a similar evolution in emerging markets, where improved central bank policies and local currency borrowing have created buffers against the capital flight that defined past crises. But the most critical component of this new system is not corporate agility. It is the state. We have entered an era of extreme fiscal activism. Governments in the developed world now operate as the economy's ultimate insurer. During the pandemic, they spent over 10% of GDP on rescue packages. During the 2022 energy crisis, another 3%. This massive, rapid deployment of public funds prevents consumer demand from collapsing, short-circuiting the traditional cycle of fear and recession. This isn't just crisis response. It's a permanent stance, with governments running structural deficits that act as a constant economic stimulus. This convergence of corporate hyper-adaptation and a permanent government safety net has created what can be called the Teflon Economy. Shocks that should cause deep, lasting damage seem to slide off. This stability has clear benefits, preventing the spikes in unemployment that scar societies. However, it operates on borrowed time and creates profound moral hazard. The expectation of a bailout encourages reckless risk-taking, reflected in the simple investor mantra: buy the dip. The system doesn't eliminate risk. It transfers it to the public balance sheet, accumulating vast government debts and contingent liabilities. The bet today's investors are making is not that geopolitics no longer matters. It's a subtler, more dangerous bet that when crisis strikes, governments and central banks will always intervene to protect the system. The immediate danger is not another regional conflict, but the moment when the bill for this perpetual protection comes due either through unsustainable debt service in a high-interest rate world, or a systemic shock so immense, like a war over Taiwan, that it shatters the shield itself.